So our system, I have a thing I put in my chairman's letter years ago called the spaghetti chart. We set up, not all Dodd-Frank was wrong. So I'm not arguing that. I'm not arguing that all regulation is wrong. But you got to take a step back at this point, a Byzantine system. We set up multiple regulators. There are 7 responsible for mortgages, 5 responsible for exchanges, 3 responsible for this. They can't even agree among each other what to do. So it literally cripples them. And then I look at this GSIFI, which probably you don't know about. The calculation is completely asinine. CCAR doesn't work. Basel III was ill-constructed. And cutting across all that, resolution recovery is 80,000 pages long. It will never work. It's a complete waste of time. And so you have this system now, and what have they been doing for 10 years? Just adding more. Liquidity, LCR, GSIFI, TLAC, this thing. So some of those things are good, but you should also ask yourself, what they missed was the opportunity to take a step back and say, how do you build the best financial? We have the best in the world, so just keep that in mind.
Well, on that point,
but they should have stepped back and said, what do we want? What do we want in the system? What do we want out of the system? How much resilience do we want? Do we want bankruptcies? Do we want more insurance? Do we want to favor small businesses? They never did any of it, ever. Nothing. No cost-benefit study, no analysis, no expected outcomes, zero.
Well, on that, you talked a lot about the micromanagement and the level of regulation on many activities. You know, going back to the previous point, if we had sort of more skin in the game, more equity capital, and as a result could back off on many of that micromanagement of the asset positions and things like that the bank is having, is that a good trade-off in your mind?
No, because the equity capital isn't going to fix any problem. And then you're creating huge arbitrage opportunities, which, look, if the regulator said, we want lending outside the system, so be it. Say it. I'm fine with it. We'll deal with it. We'll figure it out. But they don't. So if I have to hold, 2 times more capital than private credit, which is what it is today, then it belongs over here. And and in some cases, by the way, it's 5 times more because of insurance accounting rules on how they look at credit. Now, of course, is that going to last a crisis? And this is the other thing about the future. Will these insurance accounting rules that are arbitraging credit in the marketplace going to last when the shit hits the fan? They won't. And then you have another crisis, a major insurance company go bankrupt or something like that. So yes, if you wanted to drive it out, go ahead. But again, if you look at these things, it was more about liquidity than it was about capital. And you also have to ask, what do you want the financial system to do? Banks are kind of, think of it as flexible capital. A lot of these other investors are not. The banks are flexible, and we're there in thick or thin, financing our clients, regardless of the environment. These people won't make a loan if things are bad. And you really have to be very careful when you design a system. What is it you actually want? And so hopefully we'll engage in some of those conversations sometime soon.
Well, you talked about private credit. Let me push on that a little bit. So, we've seen big growth there. We've seen sort of the Apollos, the Blackstones getting into private credit. We've seen the business development companies serving the mid-market. 2 things. One is when you look at those institutions, they are much more equity funded, so have more long-term capital backing them. So in some sense, we don't see that arbitrage, I think, that you were talking about, right?
No,
they have much more equity-based funding.
No, they don't. Some do and some don't. So the insurance companies don't. A private credit fund does. They might be leveraged, 2 to 1 or something like that. But what you guys don't see is there are multiple layers of leverage in there too. They borrow against those loans. They have subscription lines over here. They pre-fund some of these other investments. Literally, you don't all see all that stuff that takes place. But yeah, in some cases they're safer. Like an insurance company, in fact, does have, if you're an annuity company, you may have longer dated liabilities and you have better liability matching than a bank might have. But you have to ask, and that's fine. So some are, and they're quite good at what they do, so I'm not criticizing that. But is that what you wanted? 80% of the mortgage business is outside. And I'll tell you another consequence, which I'd love you guys to study. Who looks at public capital markets here? Is there a professor who does public capital markets? We've gone from 8,000 public companies in the early 90s to 4,000 today. The 8,000 should have gone to 16,000. Okay, private equity's gone from 1,000 to 10,000. And I'm not, again, this is not a statement about against private equity. The question is that a good thing? Is a public market transparency good? Is having mark-to-market capital good? And why did people leave? And if you analyze why people left, it was litigation, regulation, the compensation schemes, boards have to cross T's and dot I's, it's the SEC, it's frivolous shareholder meetings, it's NGOs trying to get your company to do all these various things. People leave. I would leave the public markets if I could. But is that what you want? I think it's a bad idea for America. And so I think people should answer those questions before they say, I'm just going to impose more things on them. Because remember, the public markets are very transparent, and we have the best financial system in the world, including private credit and private equity. But I would go back to the thing, if you're going to regulate certain things, regulate the product the same. I would be more in that mode, and including inside insurance companies. So you have the market competing, but it's not arbitrage.
It's a great question you raise around the size of private equity and private debt and sort of the growth in that industry, and a good question to come back to. I want to turn to another set of regulations about consumer protection. We had Rohit Chopra here last week. He's former head of the Consumer Financial Protection Bureau. I guess it's fair to say you aren't exactly buddies. But can you talk a little bit about, do we need a regulator who's watching out for, those consumers who are less financially sophisticated to prevent, charging excessive or hidden fees to consumers and so forth?
Yeah, of course.
What's your view on that?
Of course you need proper consumer protection. And again, it goes back to how you design it. And then someone made a statement recently, well, if they don't have it there, the banks would have consumer. We have consumer protection in the OCC. We have consumer protection in the Fed. When they did the CFPB, it was supposed to go to one place. It stayed in all three. We also get it effectively from the SEC. We get it from a whole bunch of other people, sometimes from the DOJ. Of course you want proper consumer protection. And I have no problem with Rohit. I think he's very smart. I think he's arrogant. I think that he's one of those guys, I told him, which is a major intellectual flaw, is when you use your brain to justify what you already think. And that's what he does. He came in with a mission, and some of the stuff he knew wasn't exactly right, but it was kind of like, no, that'll show them, when he didn't mind unlike some other people, didn't mind being sued. Not everything he did was bad. I'm not against it, but there should be very thoughtful stuff about what is you're trying to accomplish again, and so some of his stuff was misguided, but I actually respected him for his intellect.
You talked about, the fact that we do have protections that are mandated through OCC and other places, but is there sort of a tension between, say, the OCC, which on the one hand has to look out for safe and soundness of the banking system, and therefore may be worried a lot about banks' profitability and so forth, versus having a separate agency that will think more specifically about sort of consumer products and what might be misleading for consumers.
So the consumers are being screwed all over the place, okay? But it's not from the banks generally. And I just, there's payday lenders, there are cash pawn shops, there are all these various things. The banks, the fees are up front and stuff like that. And you have to ask yourself, yes, if you had the CFPB, you're going to have a piece that does banks. I would leave it in the OCC, because I think the better way to regulate someone is that you're regulating the whole bank. And so if you think our OCC spent the last 10 years on safety and soundness, they did not. They spent the last 10 years on consumer, politics, NGO, virtue signaling. So you're dead wrong right from the start when you say that the OCC should have been safety and soundness. If you look at what they do with these banks, they do CRA, that's consumer, we are the biggest affordable housing lender in the world, the most bank-on accounts in the world, but obviously you need proper consumer protection. But then when you set up a system, a payment system, and you talk about like overdraft, something like that, make it fair, make it reasonable, it's optional, you don't have to do it, you don't have to do it. Why are you doing something like that? So when he wants to set up a system that you can't do it at all, that'll push more people into payday lending. That's all. If that'll be the outcome. So he may sound good, that would be the outcome. When they changed the Durbin stuff, I'm not opposed to some of it, 5 million people got unbanked. That was the outcome. And our government does this without regard to outcomes. They do it because it's ideology. And the real world isn't that way. And people should really analyze these things, say, what do we want? How do we want it? How can we incent good behavior? How can we get rid of bad behavior? And so you got to be a little, and there's a lot of taking place now, a lot of what I call a liability shift. The banks have to pay for this, and the banks have to pay for this. Like a third of, I think 50% of the scams that we have go through social media. Scams, not fraud. This is where the person thinks they're paying a friend or something like that. And we beg social media to stop. They have no idea who these people are. They do nothing about it. And they say it's the bank's problem. And that's not the way society should run. And so the regulators, if you had a regulator that was in the OCC and consumer protection, they might take a little more of an interest about the other side and get involved in that. That you got to stop people from using social media to try to scam people, older people.